Okay, Adam, thanks for sticking around with us. It's great to have you. As two Canadian boys, I must say I'm a little mesmerized by your accent. Where are you from, Adam?
Yeah, I'm from Mississippi in the deep south of the United States.
It's awesome, and I just kind of think it's funny that here we have a very sophisticated kind of financial trader in Mississippi. How did you like? Did you go to business school?
No, absolutely not.
I,
So,
I like
I mean,
that
how I got
answer. No, I didn't.
no, I mean, how I got started is that I was interested in finance in high school and in early college, and I was originally a computer science major, and then I transitioned into finance, but I think it was my sophomore year, and I was like, hang on, I don't actually know if I will be happy with like the day to day life of this career, and so I was like, let me put a pause in this degree, let me go actually try it out, and if I like it, I'm gonna finish it. If I'm not, if I don't, I'm gonna pivot, and so in that year off, I found a CTA that needed some help, and I was very happy with that job because it wasn't like some regular internship of light work like get people coffee. It was truly a thing of like I'm going to teach you how to be a quant and like design a model. And so I did that for a year, like fell in love with that. Went back to college. I went to Ole Miss. It's the big like state school down in Mississippi, and then got a degree in financial management. And then I started my RIA the day after I graduated. So it was a very quick transition.
Well,
Nice.
that's great. Okay, so you got some charts that you brought along and that we didn't get to because you gave us a lot of stuff. So why don't we dig into some of them, and why don't you tell us what's on your mind?
Yeah, yeah. So what this is, I actually haven't published this post yet, but the whole point of this chart is showing for people listening, just audio, it compares two things. One portfolio that has, it's just like a regular 60/40 US stocks, US bonds, and then another version of that portfolio that carves out 5% exposure to gold. And I'm showing this chart not to knock gold or anything like that. But here's what I do take issue with is that in not just the gold community, but a lot of like alternative investments, they're typically pitched as sort of like an after, which is, you need to have some, so just sock away, 2 to 5% of your portfolio in it, and it'll be there when you need it in the future. And the reason why I take issue with that is because the data is quite clear and that a 5% allocation doesn't matter. Like, so for those looking at the chart, the two lines, it shows the performance between the regular 60/40 and then the 60/40 with 5% gold. It's the same line. There's no difference. And so while it might help you sort of like sleep better of having a small allocation to be it gold or like liquid alternatives or whatever, it doesn't matter. So if you're going to make these sort of different allocations, you should either do it in size with like a substantial allocation, or you should not do it at all and like save yourself the fees.
That's great. You know what? I was just like, you mentioned Old Miss, so I must admit, while you were talking about gold and
What?
changing the stuff, I realized Blindside, is that not from is that from Old Miss? Is that where they
Yeah,
went?
yeah. So that player, he played at Ole Miss, and yeah, that Michael Orr guy. Weird story. My one of my roommates in freshman year, they was like close with that family, and yeah, basically Blindside, big in Mississippi and Memphis, Tennessee too.
So it's all true.
Oh yeah, yeah. That's all
Yeah.
accurate.
And so where you and so you had a friend that was his like a pal or a roommate of his.
What
Like,
it
did you go
was,
drinking with him?
no, no, I never went drinking with the football player himself. What it was is my friend went to what was it? He went to the high school in Memphis of where that guy came from, and sort of like got his first start in football. That sort of led to Ole Miss, then NFL, and anyways, but yeah, no, all that story is completely true.
Oh, that's a terrific story. Okay, so let's go on. So the gold, you should, if you do it, I like that kind of conclusion that if you're going to do something, you do it in size.
Yeah.
Let's go on to the next chart. What do you have here for us?
Yeah, so this is a little bit more like longer term stuff than the stuff I know I've read from both of you. But what I'm getting at is when it comes to like the ETF world and like the whole financial advisory world, products like smart beta stuff and factor funds are very popular, right? They sort of imply that a portfolio edge is a mouse click away. All you got to do is tilt towards value, momentum, low volatility, et cetera. And all those products like smart beta and factor funds, they're pitched as satellite allocations to a core portfolio, right? So it's like, have your S&P, but layer on some value, right? And so what this chart shows is two portfolios. One, which is a very basic 60-40 on the right-hand side. It's got, 30% in US stocks, 30% in international stocks, and then 40% in bonds. It's like a super low cost Vanguard portfolio. The one on the left, think of it as like the ultimate slice and dice. Like you're putting some money into value, you're putting some money into small cap, gold, REITs, tips, floating rate, et cetera. And the whole point of this chart for audio people not listening is it's the exact same portfolio under the hood. On the surface, very different, right? Like you've got all these minuscule allocations. But the truth of it is that when you never sort of have conviction to sort of put a big allocation to a truly different asset class and you sort of sprinkle a little bit of this and a little bit of that, it aggregates up to the exact same P&L profile. And so here's the issue is the reason why people pursue portfolios on the left, like financial advisors, is because it looks like you're doing something. Like somebody looks on their statement and they look on their statement, they're like, oh my God, look at my advisor. He's got me on all this stuff. He's obviously very smart and this is going to give me an edge. And the truth of it, the truth of it is that it's sort of seduction by complexity and it's throwing the wool over the eyes of people who don't see the portfolio for what it really is.
So, Adam, for such a young guy, you have wisdom beyond your years. I have a question for you.
Yeah.
Are you able to go and actually sell people on the right-hand portfolio, that of 3 positions, like a typical 60-40, or is there a huge pushback on that and they want the complexity? They want to feel like you're doing something?
Well, first off, I appreciate the wisdom comment. I still have a lot to learn. But when it comes to the like what sells, what doesn't, I'll be very honest. Like when I started, I was way more the left than the right. I had complex models, complex allocations, and that sold very well at the beginning because everybody with all these active managers, they implicitly are betting of, this guy's got the secret sauce. And as time changed, I just took a really hard look at what works and what doesn't work. And let me be clear, I am not investing people in, fully passive 60-40 portfolios because the truth of it is you can go do that yourself. You don't have to pay anybody. And so when it comes to like how I manage money, I'm effectively 50-50 active passive. That 50% passive is very similar to what you see on the right-hand side. The 50% active is I don't call it proprietary or anything. I literally put my entire strategy on my website. It's movement.capital/strategy. I run 2 active models. One is focused on the probability of recession and it scales equity exposure accordingly. The second one is a trend following model. And basically, as long as the trend for US stocks or global stocks is positive, overweight, if trend is negative, underweight. And let me explain too, when you evaluate an advisor, you have to look at them from sort of like, I think 2 angles. One, which is the cost of entry. What is their fee structure, right? And then 2, which is what is their implementation cost? What does it cost you to run their strategy? And so for me, I sort of made a business decision a year or so ago, and I started like everybody else. I was charging, 1.5% of NAV, and I looked at it, and it didn't strike me the right way because I would have one client with, let's say, $1 million portfolio, then another client with $100,000. I was charging one person 10 times as much, and I was doing the exact same amount of work. And to me, it didn't resonate with me, and so I changed my billing setup to flat fee. So like, I don't care what your portfolio size is, I'm charging you the exact same amount for investment management. And full disclosure, I charge $3,500 a year for that. The margins for financial advisors, it's in the planning as it should be. Because financial planning is the thing that's either really simple, like let's say somebody's 30 years old saving a bunch of money, there's basically no planning. They just need to save as much as they can. But for somebody who's recently retired and let's say they're concerned with like, maximizing the tax efficiency of their portfolio withdrawals, and let's say they, want to set up college plans for their grandkids, there's more work there. So therefore, that's where I should get paid more because I'm having to work more. And so for me, I know that was like a tangent, but when somebody comes to me, I make it really clear that like what you pay me needs to scale with how much I work, and not necessarily how many positions are on a statement or the size of your account.
Yeah. You know, Adam, that's interesting. I just went out with an old friend the other day who works at a family office that he's recently come back to Canada. He's working at this high net worth family office that tailors their kind of their services for really, really rich people. And they actually don't work on an AUM basis at all. They're very similar to you. They just say, we think we're going to, spend X hours on your portfolio, and therefore we're going to charge you Y.
Yep.
And that's how they work it all. But one of the things when you mentioned that you said something about your proprietary model for estimating what the probability is for the economy going into recession.
Yeah.
Where do I find that? Like, how you want to talk a little bit about that? I'm curious what your model's saying right now.
Absolutely. And so, yeah, I want to make a point too. It's definitely not proprietary. If anything, it's open source. Like I put out the whole model on it's movement.capital/strategy. There's no .com or anything. So it's movement.capital/strategy. And if you want to dive into I call it the macro model. All it does is it scales a client's equity exposure based on the probability of a recession. A portion of their equity exposure. It's not a binary thing of like yes or no. But when it comes to the actual,
I think I have it up here.
Yeah. So you click on that macro model link.
So choose the macro model on the right there.
Yep. Yeah. And so what I'm doing is I'm looking at basically three variables. I'm looking at retail sales, industrial production, and the unemployment rate. And these three indicators, it's sort of this, broad picture of the U.S. economy. You got retail sales looking at, health of consumers, industrial production, business activity, unemployment rate, which is the strength of the labor market. And for both retail sales and industrial production, I care heavily if those two indicators are negative year over year, right? Pretty much every single recession we've had in the past has been associated with contracting retail sales, a weaker consumer, or contracting industrial production. The unemployment rate is a little different in that I don't look at it on a year over year basis. I'll look at it relative to a moving average, aka whether unemployment is rising or falling. Unemployment rate, it's like this beautifully trending time series in that it's not volatile, it's not noisy. When it falls for multi-year stretches, and when it rises for multi-year stretches. And historically, recessions have always been associated with a weaker labor market, more people getting fired. And the way I sort of distilled this down to positioning is it takes two of those things to knock me out a little bit of equity exposure. And so, for example, in what was it? Late 2015, early 2016, industrial production was negative year over year. We had that very mild, manufacturing recession. But at that point in time, that was it. Like the consumer was pretty healthy, the labor market was strong, so therefore didn't pull out. But in periods like 08, 01, et cetera, when two of the three sort of like went negative, and you can sort of scroll down this page to see that. To me, that's when I went in and sort of like slightly lowered equity exposure. And so if you scroll down just a little bit more, let's see. So right here, this second table that's looking at, during recessions, outside recessions, think of it as showing you the probability of, okay, this retail sales annual change less than 0%. What percent of the time has that been the case, outside of a recession or in a recession? Basically, if retail sales have been contracting year over year, if people have been spending less money relative to the prior year, 70% of the time, that has been the case during a recession. That's only been the case 15% of the time outside of recession. You can see the different percentages for the different indicators, and it sort of sums up to me trying to get a higher hit rate on indicating, are we in a recession? Yes, no. And so this is the macro model. I'll rebalance it every week as the fresh macro data comes in. And you might ask, okay, Adam, what positions is this actually applied to? This is applied to 50/50 U.S. international total market cap funds. Specifically, the ones I use are VTI and VXUS. Those are ETFs in the U.S. One is U.S., one is international. And if two of these economic indicators are indicating, okay, higher probability of recession, I pull exposure to those two. But if they're positive, I'm in both 50/50. I don't sort of tweak the size in between the two. So yeah, that's sort of how I assess equity exposure based on the macro picture.
Adam, that's terrific stuff. As you're doing all this, I realize how important your kind of computer background is. And I've been a big proponent for young people. A lot of times I get young people coming to me and saying, I want to be involved in the financial industry. How do I go about doing it? And my kind of feedback is always, make sure you get good computers, because that's the one thing that you can't when you're competing against the old guys like me or Patrick, is that you have an advantage. And that's how I got my job on the trading desk.
Yeah.
Back then I knew Excel, which is like, just like stupid that Excel was, something that people didn't know, but and it seems kind of quaint now, but I look at you and to me you feel like the modern financial millennial, and I'm just like so excited by it.
That's not a compliment,
and I was
Kevin.
wondering
Modern financial millennial, man.
No, I think that is a compliment. I really do. And I look I look at your stuff, and I look at your ability to do computer stuff, and I'm just jealous. And I really feel maybe you could talk a little bit about what you program in, what your advice would be to other millennials that are looking to get into the finance world, because obviously you have a very big computer science background, so you're probably more able to talk about, like, why don't you discuss with the, like, let's go down this road a little bit.
Yeah, sure.
What would you recommend to a young person graduating from university today that wanted to get into the financial industry?
Oh man. Well, what those people are going to do is they're going to, hopefully they would have looked before they graduated. They probably would have stumbled across a site like Wall Street Oasis, which talks about how to get a job in the financial industry. And the truth of it is this: is that, like, if you didn't go to a target school, like, good luck getting that first year, like, IB, analyst position. And which was sort of my case, which is I went to a non-target, like, regular state school. And the main thing I did is, when it led to, like, the computer stuff, is you have to be interested in your thing. So, for example, if you go out and let's say you buy a book that's like teaches you Python or whatever, and there's some exercise that's like how to build a Space Invaders video game, like, okay, you're going to see that and you're like, this isn't getting me closer to what I want to achieve with this skill set, right? And so to me, the thing that you immediately have to try is, like, try to solve for what you care about. So for me, I think we talked about, like, the hedging stuff. I had to get at least semi-literate with Python to be able to run that analysis, because that's immense data work of A, getting the source data, the option pricing, daily. B, as we all know, options expire. You have to splice together sort of that rolling time series. And so I would say two things. One, which is pick something to get interested in and solve it, rather than, like, being like, I want to learn this new thing and, like, watching Khan Academy videos, because it's going to be boring because you don't care about what they're actually teaching. And so I like to sort of, like, hack it together at the beginning. Then I'll say this: you sort of mentioned Excel, and you used the adjective quaint. I still do most of my stuff in Excel because it's really powerful. And, like, I don't think people should dismiss it, because if you're good with it, you can sort of crunch numbers every which way. And so I still use Excel pretty much every day. And then I would say, I don't know what else. Here's probably the most important thing: is best thing I ever did was take a year off and actually sort of, like, put a pause in my life and say, okay, I've got this idea that I want to go into finance. And what I knew is, I talked to people who graduated a couple years before me, and they're like, man, I got this degree. I loathe this job day to day. I wish I could go back to college, redo, have a different major. And so rather than, like, immediately assuming you want to be a master of the universe and, like, be in the next Market Wizards if it's ever written, like, and you're in college, like, take time off, try to land a good internship, and you really might look up and be like, this is not what I thought it was. And so you can only figure that out for yourself by, like, actually doing the work. So I would say seek that out, like, quicker rather than later.
That's some great advice, Adam. And one of the things that you say that Excel is actually more powerful and that we shouldn't dismiss it.
Oh yeah.
I actually agree. I was in New York the other day, and I kind of reached out to some people and said, anyone want to go drinking? And some younger guy that was a volatility trader, reached out, and we ended up at some bar in Chelsea or something. And he was he was a real quant. Like, I'm pretty sure his degree was in, like, a rocket scientist and stuff like that. And I asked him what he programmed in. He says most of it is Python. But he was laughing. He said that the front end of what he kind of uses to display it all is Excel still.
Yeah.
He says, Excel does a lot of really good things. And he talked about Excel Wings, which is kind of a Python library or something that enables you to use both Excel and Python together. And he was a big proponent of that. So just a question for you is, so obviously being good at Excel is kind of, I would say that's the bare minimum. Everybody should be, a young person should be good at Excel. Is it Python? Like, I know you do a lot of Java. I'm assuming you do a lot of, web development. Your websites are beautiful and they're terrific. And you must know a fair bit. Like, is that JavaScript you're doing? Like, is that what you taught yourself there?
Yeah, so all those charts is it's a blend of like JavaScript and CSS. And it's honestly, that's not difficult stuff. Like, it's the same chart every time. It's pretty much like a layered line plot. So you got 2 lines at the bottom, you got a big line up top. And that was JavaScript. JavaScript's powerful in that you can make stuff look beautiful on the web. CSS is sort of not so much the charts, but more so designing the whole page. And I'd actually say this: if somebody was interested in making like pretty stuff online, I wouldn't go down the rabbit hole of teaching yourself like CSS and HTML, because 10 years ago, if you wanted to make a pretty website from scratch, you had to know the code. Nowadays, all you have to have is a good-looking WordPress template and a WordPress, website, which is free. And so to me, I would spend zero time like learning HTML or CSS. And there's a lot of JavaScript charting solutions that are pretty much off the shelf. I've like lightly tweaked mine, but I think that what I'm getting at is, regardless of like Excel or JavaScript or CSS, chances are the thing you want to make has already been made. So find it out and build on top of that, as opposed to like rebuilding from scratch every time.
Right. So then would you say that really Python is what they should be learning?
No, because so to be honest with you, my use of Python, I only defer to it if I need a lot of data prep on the front end. So for example, I did not use Python at all for this graph on the screen. This was all Excel. But for like that option rolling thing, that was a Python thing, because I had like 1,000,001 CSV files for like daily option pricing, and I needed to sort of like combine it all together into one big thing. And so I wouldn't even jump at, you got to learn Python. It's a big function of what you want to do. So if you want to put out these like, if you want to do like crazy work with like option strategies or like futures rolling stuff, it's like you should probably lean towards Python, because you're going to have a lot of data prep. But if you're doing really basic stuff, like I want to look at, market correlations or like how different portfolios have performed, you can do all that in Excel, no problem. So it's just up to what you want to do with it.
It's interesting you say that, because actually George Perks, I don't know if you know him from Bespoke Investments.
Yeah, his stuff is great.
He's the same way. Like, he's a terrific guy. He's also Canadian, and so I'm a little biased towards him. But he, I reached out and chatting with him, and he says, like, I'm learning Python, or I can't remember if it was Python or R, but he was learning one of them. And he says, but, the reality is I can do most of the things I want to do in Excel. Yeah. And, I think you're kind of echoing the same comments that he has.
Yeah.
But anyways, listen, do you have any other charts that you want to go through?
Oh, yeah, I was going to push you on this, because I needed to know what's going on here on this 10-year Treasury bond chart here. What are you trying to show here?
Yeah, so actually, I brought this chart back because I remember months ago, I think either I shared it, Kevin shared it, something, and it got like a lot of engagement. And I think people found it to be sort of an interesting chart. And what it's showing is sort of the rolling 10-year inflation-adjusted return of a position in the 10-year Treasury. And there's very, very much, two discrete periods. There's the 1926 to 1981 period where, and this is a nut statistic, but if you would have been invested in 10-year Treasuries, you would have had a goose egg at the end of it, as in a real return of zero, right? And then ever since, rates sort of have been going down since 81. It's been the biggest bond bull market ever, and that's a crazy statistic, which is on the right-hand side. You can see the annualized real total return of the 10-year Treasury has been almost 7% real since 81, which is that's stock-like level of returns. And so this chart, the whole point of it is that most people, when they think bond exposure, they think boring, linear ride, and if anything, it's the opposite of that, right? And so I have this chart in here for a reason. If you go to the next, there's some context around it. No, keep on skipping until let's see, go to the right. Perfect. Okay. So this is another sort of research project I did, which is, most people with their regular portfolios, they got some stocks, they got some bonds, and I wrote this post because I think that people's expectations for bond exposure are too optimistic. Basically, since the year 2000, bonds have done extremely well whenever the S&P has gone down. And what this chart is showing is every single 10% or more correction in the S&P since 1987. And so you got the magnitude of the correction on the left, then you've got the change in, 10-year yield basis points in the middle. Then on the right-hand side of those numbers, all that is the performance of different bond asset classes during that correction. And if you look at the change in 10-year yield, you can see this sort of relationship that started in the year 2000, which is pretty much every time we've had a correction since then, yields have come down, bonds have risen, and bonds have like massively diversified stocks. They've helped out a lot, right? The point of this is to show that that is not the norm. Before, from like 87 to 99, more often than not, yields actually rose when stocks had a correction, meaning that bonds, stocks cratered and bonds didn't bail you out. And another part of this chart that's important is I think people have been sort of seduced by taking more and more duration as this bond bull market has continued. Like it's sort of like a Pavlovian thing of they've always been rewarded for if some duration is good, more is better. And what this shows on the that very bottom line is that long-term U.S. Treasuries, specifically this is for TLT, it's got a duration of 17. They've averaged an 8.6% rise when the S&P has fallen 10% or more. But that performance is concentrated in the post-2000 period. Pre-2000, long-duration bonds did not help you out. In fact, they did even worse than intermediate-term bonds during when the S&P is corrected. And so I think there's another chart, either go to the right or left. I don't know the positioning of it. Yeah. Okay. So this is an awesome chart from GMO, which is you might see all that data of like, okay, since 2000, bonds have really helped. Before, they didn't really bail out equity investors. Why is that? Like, what happened in the year 2000? This is not a novel point. Very smart people like Chris Cole, whatever, they've all noted this, which is the relationship between the correlation of stock and bond returns really changed around the year 2000. And ever since, bonds have been a lot more negatively correlated to stocks. And obviously, if you have a portfolio and you combine two assets with negative correlations, that lowers volatility and it means they diversify each other more. And so to me, people might think that's the norm for bonds to sort of zig when stocks zag. That's not the case. You go back to 1882, on average, they've sort of exhibited this this mildly positive correlation of about 0.2. And the takeaway, this isn't all, information for the sake of it. The takeaway is this, is that if you've got a portfolio and you got equity risk, you got bond risk, okay, the past 19 years have probably set too high of a hurdle for both the level of that portfolio's volatility. It's probably been lower than average because the correlation's been negative, but then also, in a year like '08, when like long-term treasuries ripped, you can't always depend on them to do that. And to me, I think Kevin and I have actually talked about this, which is, bonds aren't the thing that they used to be when it comes to their ability to outperform in a substantial correction. And so I just think people who are running portfolios need to sort of like rebase their expectations to the more normal relationship between stocks and bonds.
All right, so Adam,
Okay,
I'm coming in here, Kev.
No,
Stop right here.
No, Patrick.
Stop
Patrick,
right here.
Before you say anything, I got to tell you something, Patrick. I've been sitting here. It's Kevin speaking.
Yeah.
Biting my fist because I am got such a big smile on my face. Adam is my people, man. I wish I could have articulated that as well as Adam did. That was the best argument I've ever heard, and I just think he did such a terrific job.
Oh.
I actually think, Patrick, you just you might as well just give up. Like, don't even argue it. Argue it, buddy.
I was gonna say. No, Kev, this is to be continued. Now, so Adam, Kevin and I are going out to Chicago to the the Trader Expo there, and we're going to be speaking there, and we're going to throw the gloves down on the bull bear debate on bonds. And
Patrick,
I assure you that he's going to be pulling your charts out in
exactly.
this.
I actually might just recruit Adam to come and do my job for me because he did such a beautiful job. This is
and I am not going to say another thing. I am saving it. I'm saving it for the stage.
I just thought, Adam, that was. So go ahead, bud.
I don't want to label myself as necessarily a bond bear because I do understand the other side. Demographics are destiny, yada yada. We can sort of repeat. We can be JGBs for the next 20 years, yielding zero. I get that. What I'm talking about is the fact that, okay, so for bonds to generate this sort of monster portfolio boost in the next recession, you have to have rates go to sub, June 2016 levels. And to me, in sort of investing, it's a game of probabilities. To me, that's probably not a high probability scenario. And it's not necessarily that, bonds are going to reverse and we're going to completely undo this bull run in bonds, but it's sort of like there's just less meat on the bone of what they can do.
Yeah, bingo. It's like,
oh my God! I am.
1 second. Adam is right because for the past 30 years, real rates have been substantially positive, and there's been a lot of room for the compression. But anyways, let's save it for the Traders Expo. And just for everyone knows, it's John Netto is actually is moderating it. Does he know what he's got in store for him?
He has no clue.
No, Patrick,
we're actually going. We're going to be bringing him actually onto the huddle in the weeks prior to that. I think we're going to have to squeeze him in July sometime so we can warm up our listeners to this. But it'll be good.
So,
it'll be good.
I'm gonna end there because Adam, that was so terrific. I just feel like anything else would spoil. It's like Michael Jordan sinking the basket, and just like anything else would be like coming back and playing for the Wizards. Like I think we should just like stop right there. So Adam, Fair enough. Last time, where can people find a little bit more about you and your firm, and if people want to contact you and talk a little bit more about the correlation breaking down between stocks and bonds in the coming years, where would they find you?
Yeah, so Twitter is @movement_cap. My email is adam@movement.capital. And then the firm website is movement.capital. There's no .com or anything. And like I mentioned, I put all my strategy stuff out there. So if you're like, how is he positioned right now? I'm transparent with it. So at movement.capital/strategy, that's literally outlining the model positioning and what I'm allocated to at the moment.
Well, terrific. It's been a pleasure having you. Adam, it's been so tough because everyone I get on is one of Patrick's disciples that's always so bearish and stuff like that. So it's been a pleasure having someone that thinks somewhat similar to me. Thank you so much for coming, Adam.
Yeah, I've thoroughly enjoyed it. Appreciate it.
Thanks a lot, Adam, bud.